Good day. Today I'm reviewing Barbados' economic performance for 2018 and sharing the bank's forecast for 2019. 2018 was challenging for the Barbados economy. Economic activity remained sluggish, but the decision to enter a 4-year economic adjustment program with the IMF, the suspension of commercial external debt payments, and the restructuring of government's domestic debt renewed confidence and contributed to an improvement in the public finances and the stock of international reserves. Government unveiled its Economic Recovery and Transformation Plan, which aims to deepen the fiscal adjustment effort and to undertake structural reforms to stimulate medium-term economic growth. The public finances strengthened, as evidenced by the timely payment of current year tax refunds, the curtailing of new central government arrears, and reduced reliance on central bank financing. The completion of the domestic debt restructuring and the enhanced outlook for fiscal and debt sustainability over the medium term contributed to an upgrade in Barbados' credit rating for domestic securities. Structural reforms have proceeded apace, with new legislation to strengthen oversight of state-owned enterprises and to modernize the Town and Country Planning Office now being debated in Parliament. In addition, the government reformed the corporate tax regime in response to the OECD's Base Erosion and Profit Shifting Initiative. This resulted in a comprehensive amendment to the tax structure for the international and domestic corporate sectors. Real economic activity contracted by 0.6% in 2018 as moderate gains in tourism were outweighed by the fall-off in manufacturing and other services. Tourism output slowed to an estimated 0.6% from 2.2% in 2017. Long-stay arrivals were 2.8% higher than the previous year, owing to intensive marketing and an increase in airlift. However, the expansion in the sector was contained because the average length of stay declined, a result of the increase in the shorter staying visitors from the United States market. Arrivals from Canada and the United Kingdom were both up, with the latter recovering from a mild reduction in the previous year. Construction fell by approximately 7% following moderate growth in 2017. This outturn reflected low levels of infrastructural development in the public and private sectors, evidenced by reduced quarrying, cement consumption, and lower imports of other construction materials. The average unemployment rate for the 4 quarters ending September was 9.2%, compared to 10.2% a year earlier. However, public sector layoffs impacted unemployment in the 4th quarter. The uptick in the 12-month moving average measure of inflation tapered off during the second half of the year. Imported commodity food prices remained stable, but the pass-through effects from the 2017 hike in the NSRL, together with rising oil prices, pushed up inflation during the first half of the year. The elimination of the NSRL and the softening in international fuel prices in the 4th quarter helped to contain the inflation rate to 3.7%. The international reserves, which had declined since 2012, increased by $576 million to $1.05 billion at year-end, the highest level since March 2013, and equivalent to 13.5 weeks of import cover. This outcome was initially influenced by improved availability of foreign exchange that allowed FX dealers to increase their sales of foreign exchange to the central bank, and by the savings from the suspension of debt service that enabled reserves to stabilize, particularly during the middle of the year when they were critically low. During the last quarter, capital inflows for policy and project loans of over $470 million from international financial institutions boosted foreign exchange holdings further. The improved performance of the foreign exchange market reflected higher net private sector inflows and a modest improvement in the external current account deficit to 3.8% of GDP. Rising tourism earnings aided in narrowing the deficit, as the sector benefited from higher arrivals and improved room rates. Domestic exports were flat, as the gains from exports of chemicals and printed paper labels were outstripped by declines in rum and sugar exports. Total imports fell just under 2%, as non-oil purchases declined for the 2nd consecutive year. Capital goods and non-oil intermediate goods contracted, as imports of both machinery and construction materials declined. Consumer goods also fell by 3.3%, following a 7.1% reduction the previous year. The decline was partly related to lower motor vehicle imports and furniture. The public finances between April and December 2018 improved significantly, reduced interest costs associated with the suspension of commercial external debt payments, and lower interest rates on domestic government securities effective October 1 contributed to the outturn. However, the fiscal outturn also benefited from non-interest expenditure that was lower than originally targeted, resulting from reduced transfers and lower capital expenditure. Revenues were $56 billion below the target due to larger than anticipated tax refunds, the impact of lower imports, and a lag in the collection of some of the recently implemented budgetary measures. Government provided refunds of $54 million in income tax and $18 million in the value-added tax, resulting in lower than anticipated net earnings from income tax and VAT. Excise revenue and import duties also declined. However, the new fuel tax realized $35 million during the period. Revenue from property taxes surpassed the target by $17 million, given the collection from the tax amnesty. Corporate taxes also overperformed, despite $26 million in refunds, owing to significant first-time payments by recently registered international business companies. The foreign exchange fee yielded $56 million in tax receipts over the period. The suspension of debt service and the improved fiscal outturn helped the government to reverse the reliance on domestic funding that had been a feature of the financial landscape in recent years. Policy-based loans of $350 million from the IDB and CDB during the last quarter of the year contributed to an overall decline in central bank financing of approximately $242 million, in contrast to the increase registered in the first half of the fiscal year. Discussions on the debt restructuring related to foreign currency denominated claims on the public sector are ongoing. However, the domestic debt restructuring allowed government to erase approximately $2.9 billion or 29% of GDP from the stock of debt held by the public sector institutions. The gross public sector debt is now equivalent to 127% of GDP. The debt restructuring and the adoption of new accounting standard IFRS 9 eroded capital in the financial services sector. However, commercial banks held adequate capital as indicated by the capital adequacy ratio of 15.6%. Liquidity in the banking system remained high, with an excess cash ratio of 16% compared with 14% in the corresponding period of 2017. The excess securities ratio also increased, partly because the improved fiscal position allowed the bank to reduce commercial bank securities requirement ratio from 20% to 17.5%. Credit to the non-financial private sector declined by approximately 0.5%. The distribution sector increased their borrowings, while loans to the real estate and to hotels and restaurants declined. And now for the outlook. In 2019, government must build on the progress in restoring macroeconomic stability and engendering confidence. Efficient and timely execution of the reforms identified in the adjustment program related to tax policy, revenue administration, SOE reforms, and business facilitation will be crucial in helping the economy to return to a sustainable growth path. Over the past decade, average growth was minus 0.7%. Revitalizing growth is therefore critical, but the forecast of 2019 is for growth to remain flat. Tourism is expected to perform favorably due to an anticipated expansion of airlift, special events like the English Cricket Tour, and an increase in ships docking at the port. This activity will be supported by the thrust towards Barbados emerging as a hub for medical education. The need to sustain the fiscal consolidation effort could continue to dampen economic activity. However, this trend can be reversed through higher levels of private sector investment. Several projects in the tourism, healthcare, and distribution sectors have been identified for startup in 2019. The actual commencement date of these projects will influence the degree of expansion in rail economic activity. Significant downside risks remain. In particular, the forecast for global growth, including our major source markets, has been revised downwards by the IMF from 3.7% to 3.5%. The U.S. economy is forecast to grow by 2.6% this year, but the uncertainty related to trade tensions lingers. The latest Brexit developments can also impact economic activity in the UK, with potential effects on the pound sterling. Geopolitical factors could alter the outlook for international oil prices, influencing economic activity and an otherwise benign inflation environment. The revenue measures announced in the latter part of 2018 will have a full-year impact in fiscal year 2019-2020 as government strives to achieve its targeted primary surplus of 6% of GDP. However, government must continue to manage its expenditure to avoid any shortfalls in its targeted goals. The external debt suspension has helped to shore up reserves, and completion of the restructuring remains important to the overall stabilization effort. Placing the debt on a downward trajectory and creating fiscal space will allow for the gradual reduction in outstanding arrears to the private sector and strengthen the medium-term growth potential. These developments should contribute to a further improvement in credit ratings. Effective program implementation will facilitate additional access to funds from the multilateral agencies. These resources should enable the reserve cover to continue to grow in 2019. The road ahead remains challenging, but the commitment of the government and all Barbadians to continue the critical structural reforms will position the economy to overcome these hurdles and strengthen economic sustainability. I thank you.